January 26, 2026, silver trades at $93 per ounce. Gold breaches 5,000. Bitcoin hovers near 88,000. These are not numbers. These are coordinates on a map leading to the edge of a cliff, and Canada just stepped off. You're watching the collapse of a supply chain that took a century to build. This is not a disruption. This is a structural fracture occurring in real time, hidden beneath headlines about green technology and electric vehicles, masked by promises of sustainable mining and digital transformation. What you are witnessing is the systematic dismantling of North America's industrial metal supply at the exact moment when demand has entered exponential growth. Canada ranks 13th globally in silver production, second largest supplier to the United States. These statistics sound stable until you understand what they conceal. Canadian silver output has been declining for an entire decade, not from temporary shutdowns or weather events or labor strikes, from ore grade depletion, from aging mines reaching end of life, from the mathematical reality that the easy silver is gone, and what remains requires processing 3 times the material to extract the same metal that came freely 30 years ago. 70% of silver production worldwide emerges as a byproduct of other metals. Copper, zinc, lead, gold. This creates an impossible supply response mechanism. When silver prices double, as they have, mine operators cannot simply increase silver output. They are bound to the economics of base metals. If copper demand softens, silver supply contracts regardless of silver's price. This is a market structurally incapable of responding to its own signals. Price discovery has been severed from supply response. The feedback loop is broken. Now we need to talk about what broke it. The Silver Institute projects global mine production for 2026 at 830 million ounces. Minimal growth from 2025 levels. Add recycling at 180 to 190 million ounces. Total supply reaches approximately 1,020 million ounces. Now measure this against demand approaching 1,350 million ounces. The deficit is 330 million ounces. This is not next year's problem. This is the 5th consecutive year of structural deficit. The cumulative shortage from 2021 through 2025 approaches 800 million ounces. That represents nearly 1 full year of global production simply gone, vaporized into solar panels, semiconductors, electric vehicle components, and data centers. Canada's role in this disintegration is both critical and ignored. Domestic output has declined over the past decade due to falling ore grades and aging deposits. The country's mining sector faces what industry analysts describe as operational complexity at levels never seen before. Deeper mines, lower grade ore bodies, declining reserves. These are not temporary challenges solved by higher prices or better technology. These are geological realities. The best deposits were found first. What remains requires exponentially more capital, more time, more energy to extract. Here is where the system reveals its true fragility. Mine development timelines in Canada now exceed 5 to 7 years, even for shovel-ready deposits. Environmental permitting, infrastructure requirements, labor shortages with more than half of Canada's mining workforce expected to retire over the next decade without adequate replacement. These timelines collide with demand growth measured in months, not years. Solar capacity is projected to quadruple by 2030, according to the International Energy Agency. Electric vehicle production scales exponentially. Each smartphone, each laptop, each data center, each 5G tower, each solar panel requires silver. Industrial demand now consumes over 550 to 600 million ounces annually. That alone is 75% of total mine production before a single ounce goes to investment, jewelry, or monetary purposes. This brings us to the most dangerous signal in the entire commodities complex. Silver's price behavior compared to its supply fundamentals. The metal surged 110% in 3 months, over 230% in 1 year. These moves should theoretically trigger massive supply responses. New mines announced, existing operations expanded, exploration budgets increased. None of this is happening at scale. Why? Because the supply cannot respond. Approximately 71% of mined silver comes from polymetallic operations. Lead, zinc, silver, copper, gold, silver. The decision to mine is not made based on silver economics. It is made based on base metal economics. Silver is along for the ride. Global mine production peaked in 2016 at 900 million ounces. It has declined to 835 million ounces in 2025, a 7% drop during a period when industrial demand exploded. Mexico, the world's largest silver producer, faces mine closures at San Julián, Mercedes, Bolañitos, San Rafael, Dolores, San Dimas. These are not small operations. Peru confronts social unrest and ore grade declines at key operations, including planned closures at Cerro de Pasco and Andaichagua. Bolivia will lose the Porco mine. Chile sees the Minera Florida closure by 2030. Between 2025 and 2030, global silver production is projected to decline at a compound annual growth rate of negative 0.9% to 901 million ounces by 2030. Supply is contracting while demand accelerates. This is where the system breaks. Canada positioned itself as a reliable supplier through stable governance and transparent environmental standards. The country adopted green technologies. It emphasized sustainability. It promoted responsible mining. All of these are important. None of them address the fundamental problem. The ore grades are falling. The deposits are depleting. The timeline to replace lost production measures in decades, while consumption growth measures in quarters. Canada excluded silver from its critical minerals list, despite pressure from First Majestic Silver and 20 mining industry executives who sent an open letter to the Ministry of Energy and Natural Resources. The United States added silver to its critical minerals list in November 2025. Canada did not follow. This policy divergence at a time of supply crisis is not merely bureaucratic delay. It represents a failure to recognize what is occurring in real time. Now examine the market's actual behavior stripped of narrative. Silver at $93 is up 110.3% in 90 days. Gold at $5,088 is up 30% in 90 days. Gold rose 85.59% year to date. Silver rose 234.6%. The gold to silver ratio compressed to approximately 56 to 1. These are not normal market moves. These are repricing events. The ratio has not sustained levels this low outside of major bull market phases. But here is the contradiction that reveals everything. Mining stocks underperformed metal prices dramatically. While silver doubled, companies like Pan American Silver and First Majestic gained 150 to 200%. Some developers delivered 300% plus on specific catalysts. Many lagged significantly. The market is pricing in a backwardation of metal prices. Investors do not believe these levels will sustain. This skepticism occurs while physical markets show acute stress. Bullion Star reported rising acquisition premiums and longer delivery lead times from suppliers. Current premiums on physical silver, 1,000-ounce good delivery bars at spot, plus 5.99%, 1 kilogram bars at spot, plus 14%, 1-ounce coins at spot, plus 12%. These are not small spreads. These are crisis-level premiums indicating physical shortages, even as paper prices hover near multi-decade highs. London Bullion Market Association silver holdings have fallen nearly 40% since 2021, one of the steepest declines on record. This drawdown accelerated in 2025 due to U.S. trade tariffs prompting mass movement of silver from the U.K. to the U.S. before duties took effect. Rising Indian imports ahead of Diwali, freight bottlenecks with some U.S. traders booking cargo space on commercial airlines to move silver quickly. Physical markets are in backwardation. Spot prices exceed futures prices. This is the market screaming that metal available today is worth more than promises of metal available tomorrow. Silver lease rates spiked above 5% in September for the fifth time in the year. Historical levels stayed near zero. Holders of physical bullion demand premiums. This is not speculation. This is scarcity. The futures market operates on the assumption of abundant deliverable supply. That assumption is breaking. Exchange-traded funds show massive inflows. SLV recorded $2.57 billion in annual inflows. GLD showed 18.9% inflows in the last 3 months. Investment demand surges exactly when industrial consumption reaches all-time highs. Both cannot be satisfied from current mine output and recycling. The deficit must come from somewhere. It comes from above-ground inventories built over decades. These stockpiles are finite. As they deplete, the market transitions from deficit supported by drawdowns to deficit that cannot be filled at any price in the current supply structure. Canada is positioned at the center of this breakdown but refuses to acknowledge its severity. Policy uncertainty continues to damage the country's mining potential, according to the Fraser Institute. Despite rich mineral endowment in British Columbia, Yukon, and Manitoba, government policies deter investment. These jurisdictions rank 32nd, 40th, and 43rd out of 82 globally in policy perception, despite ranking in the top 10 for mineral potential. The Northwest Territories ranked 56th, Nunavut 59th, Nova Scotia 76th. Mining investment in Canada fell from $4.4 billion in 2022 to $4.2 billion in 2023, with preliminary numbers for 2024 suggesting a further 2% drop. Leading exploration companies including Solaris Resources, Falcon Energy Materials, and Barrick Mining Corporation either moved headquarters out of Canada or are considering doing so. This is capital flight during a commodity supercycle. The operational reality on the ground is worse than the investment statistics suggest. Rising costs and productivity challenges rank second in EY's latest annual report on mining risks. Operational complexity ranks first, complex ore bodies, deeper mines, declining ore grades, royalty increases, labor shortages, escalating trade tariffs, higher energy costs, supply chain disruptions. All of these create inefficiencies, erode margins, and hinder operational agility. Companies must compete for investment in a market dominated by technology firms. Higher interest rates and capital intensity have more than doubled the mining sector's weighted average cost of capital compared to technology companies. The industry responded by increasing capital expenditure while reducing shareholder payouts for the third year in a row. This is desperation capital allocation. Spend more, earn less, hope something changes. Nothing is changing on the supply side, it is worsening. This is where currency debasement enters the equation and transforms everything you think you understand about asset prices. The U.S. Federal Reserve cut rates to 3.75 to 4%. The dollar index fell 9.54% over 90 days to 98.19. 10-year Treasury yields dropped to 3.978%, down 4.69% monthly. CPI inflation measured 2.7% year over year in December 2025. Central banks purchased 1,045 tons of gold in 2024, 333 tons in Q4 alone. This buying pushed gold over $5,000. These are not isolated data points. These are the ingredients of monetary regime change. When central banks accumulate metal at record pace while cutting rates and running fiscal deficits, they are not diversifying reserves. They are preparing for currency instability. The Canadian dollar weakened alongside the US dollar's global decline. For Canadian investors, silver's rise in USD terms was amplified when converted to CAD. But this is not about exchange rate fluctuations. This is about what those exchange rates represent. Currencies are being debased deliberately through monetary policy aimed at inflating away debt burdens that cannot be serviced through growth. When debt to GDP ratios exceed sustainable levels, governments have three options: default, austerity, inflation. They choose inflation every time because it is politically invisible until it becomes uncontrollable. Silver rising 234% in 1 year is not silver becoming more valuable. It is the currency losing purchasing power against real assets required for industrial production. The contradiction at the heart of this entire crisis is that Canada refuses to designate silver as a critical mineral. Despite overwhelming evidence, it meets every criterion. Natural resources. Canada requires a mineral to meet one of three criteria: essential to Canada's economic or national security, required for transition to a low-carbon and digital economy, or facing supply chain vulnerabilities. Silver meets all three. The department responded that there is a robust global supply of silver and its supply chain is not threatened. This statement is factually incorrect based on the data. 5 consecutive years of deficit, 800 million ounce cumulative shortfall, mine production declining, industrial demand accelerating, above-ground inventories depleting, premiums spiking, lease rates elevated, physical backwardation. Where exactly is the robust supply? The answer is there is no robust supply. There is a supply chain running on fumes supported by inventory drawdowns that mask the structural shortage. When those inventories deplete to levels insufficient to buffer short-term demand surges, the market will experience what traders call a squeeze, not a temporary price spike. Settlement delays, speed of price movement, the gap between recognizing a problem and implementing solutions. In mining, that gap measures 5 to 7 years minimum. The crisis is not 5 years away. It is here now. Every month of deficit draws down stockpiles that took decades to accumulate. Every month of underinvestment in new projects extends the timeline before supply can respond. Every month of policy delay embeds deeper structural imbalances. You're watching the end of a cycle, not a market cycle. An industrial cycle where a critical metal required for the energy transition cannot be produced in quantities sufficient to meet demand at prices the supply chain assumed were permanent. That permanence was an illusion sustained by inventory drawdowns. When illusions break, they do not break slowly, they break all at once. Canada's silver supply is not collapsing today. It collapsed over the last decade. One closed mine, one depleted ore body, one policy failure at a time. What you're seeing now in the price action is the market beginning to understand that the collapse already occurred. The price is just catching up to reality. This is not a warning. Warnings come before the event. This is documentation of the event as it unfolds. What happens next depends on how long physical inventories can buffer the structural deficit and how quickly industrial consumers recognize they are competing for supply that cannot meet collective demand. The market will resolve this through price, always price. The only question is what level forces either demand destruction or supply response on timelines that matter. That level is not $93. It may not be $150. It could be anywhere that breaks the current stasis where everyone assumes someone else will provide the metal. No one else is providing it. Canadian mines are not expanding fast enough. Mexican mines are closing. Peruvian operations face social instability. Chinese production encounters regulatory limits. Recycling has plateaued. The equation does not balance. Something has to give. Either price or industrial activity or both. Given that industrial activity is driven by renewable energy mandates with political commitment and digital infrastructure with economic necessity, price is the variable that adjusts. Canada's refusal to recognize silver as critical during this adjustment will be studied as a case study in policy failure during resource crisis. That study will be written a few years from now when the outcome is clear. By then, the opportunity to act will be long past. The opportunity exists today. Whether anyone takes it is a different matter entirely.